Now we get to turn to Asia and some key aspects that have come out. Obviously China had their data sets. We've had some additional data that has come out from other regions, and some of it's positive, some of it's negative. There's a little bit for everybody, especially when we start turning to China. So when we look at what China has done so far, we've been talking about the issues that have come out from the 5-year plan, the Communist Congress, where they've talked about trying to slow things down a bit. And by doing that, taking some of the debt out of the market, which is going to be that hindrance to some of that additional investment. But when we start looking at what came from China, the most recent, so let's just look at, okay, well, what was the Chinese data set? So when we look at the manufacturing came in slightly better than expected. Manufacturing came in at 51.9 versus the expected 51.2. And this is what we've been talking about, where we're not calling for this huge slowdown. It's just there's going to be some of this segmented views where they're not looking to gun it up front because they're having struggle in general. Like when you look at inflation, CPI, PPI, all of these things are also originating within China, especially when you start looking at grains and other types of pressures on the commodity space. That is going to reverberate into the manufacturing because you need to purchase raw materials to manufacture, and that's why we think there's going to be some pressure, especially as we see a lot of growth in the Vietnamese, Malaysian, South Korean exports, which are going to come to the detriment of China. So people aren't going to buy from both China and other. They're going to buy some from China less, and then from other places at a rising rate to try to diversify. And again, these are those things that we're looking at when we're looking forward into that manufacturing side. Now, from what China's looking to do, which is that non-manufacturing PMI or the services side, expectation was for 52. It came in at 56.3. There's a lot of things we can say about this. This is their target, and all of a sudden their target was golden. We can go back and forth, but just based on what we saw for retail sales, it makes sense to see some acceleration. It's getting warmer. You actually had a disappointing number when we average out January and February versus the last 2 years. So it makes sense to see some of that pickup, which is a net positive. So then the composite came in at 55.3, a net growth level, but the manufacturing is the one that we've been talking about and have been concerned on when we look over the next few months. And the reason why is just to break it down a bit more. When we look at new orders, so new orders are strong. So that just means that the new orders will be supportive, but at what price? And that's when we start looking at input prices. So Chinese manufacturing input prices are now accelerating to the upside. Output prices are also accelerating. So their exports are going to get more expensive. And that's when you start layering on tariffs, which is why they've started to extend some tariff leniency, because they don't want to hinder their export capacity, but they have an extending deficit. I mean, who doesn't at this point? But this is something to look at when we're considering new orders against output prices and input prices. And then what does that mean as we go forward? So when you just take this and then look at, okay, well, what happens when Wang Yi went to the Middle East? So he's visited a lot of the key countries: Saudi Arabia, Turkey, Iran, UAE, Bahrain, Oman, and there was a lot of conversation around obviously oil. They're taking more from Iran, and this is in an attempt to bring down some of their costs, because by taking in more Iranian crude, they've actually reduced some of the cost and some of the prices of heavy sours and other sour grades, which should be a benefit when you're considering, that this is one of their big input costs. And the idea was always bilateral cooperation, COVID-19, battle extremism, hint, hint, US, and promote that regional peace and development. So then when we take this to the next level and think about, okay, well, they're focused so much on commodity prices. They're focused on, trying to get in front of some of these input costs. So Premier Li chaired a virtual symposium attended by provincial governors. China's economy is affected in many aspects, especially in surging commodity prices. So again, they're not stupid to what's happening within the commodity world. Employment pressure and slow recovery in some industries remain a problem. This is what we're talking about. It's not an equal movement. There are some places that are moving great, and there are some places that are seeing a lot of pressure. And this is what they're trying to address, because the manufacturing side, if we just look at what exports are, what the boats are telling us, there's a little bit of a slowdown that is on that horizon, and they're trying to get in front of it. And he's they're trying to show how the local governments can help. So policies ensuring job security, basic living needs, again, basic living needs coming back to grains, and the operation of market entities should be maintained, directed, and direct funds should go quicker to the primary level. He urged local officials to slash taxes and fees for small and micro-sized enterprises and explore ways to further support individual businesses. These are some key aspects, because the small local side, coming back to the consumer and the pressures we continue to see, they're trying to adjust, because the consumption side is what they're trying to develop. Again, back to that non-manufacturing PMI, that's what they're trying to push up. They want the non-manufacturing side, the services side, the general, like, and we'll get the Caxton PMI services in April. This is what they're trying to drive up. And more efforts are needed to expand employment, increase incomes, and stabilize prices. Again, the consumption remains the push. So when you think about the level that we have with those input prices, output prices, this is why we keep talking about and keep harping on water commodity prices, because this is going to be a problem for what is going to happen in the longer term for growth in China. So then when we take from the general office of the CCP, on the organizational punishments, they're still trying to drive home the Marxism way, which is showing this, how do you get in trouble, if you're an official, showing disloyalty on major principles, having insufficient beliefs in Marxism, doing an inadequate job on policy implementation, overruling or ignoring decisions arrived at by senior government bodies, i.e., if you go against Xi and the CCP and the Elite Seven, that's going to be a problem. Neglecting duties or carrying out responsibilities in a perfunctory manner, wasting resources on flashy projects, cultivating personal power, and forming cliques. Again, all of that is trying to mitigate power that could arise from what is happening within the party. Last week, we talked about how they're trying to increase party involvement in education, because the younger generation is not coming up in the party ways at the same level that people who are 50 and 65 years and older. So they're trying to incentivize that, while also warning some of the younger individuals, don't form a clique. Don't try to challenge, because you're going to lose. And this is where we start to see some of these cracks forming within the party in general. And back to the point that this is a bigger part. This is a part of a bigger project. Since Xi took over the party in 2012, over 70% of all existing party rules have been overhauled or rewritten. Again, coming back to how is this going to be structured when you look at trying to drive that new level. And then on the geopolitical side, warplanes of the Chinese People's Liberation Army again surrounded the island of Taiwan from both west and east. This time they had about 20 ships, 20 planes hitting from different sides. This is something that's happening and ratcheting up, and is in response to the U.S. working much closer with the Taiwanese Coast Guard, which is going to be something to watch as we come into the spring thaw, because the spring thaw is going to be very important when we start looking at what is happening between China, India. India and Pakistan have already had their high-level military agreements and talks. Pakistan is not in a position to fight. India is going to want to limit the amount of fighting, just because they have China to worry about and their own economic problems that they want to try to manage on some of these key levels. So then when we start looking at some of the defaults, which is why we keep talking about the debt side. Debt defaults among China's onshore corporate borrowers have surged to $5 billion in March, set to be the highest monthly tally on record, according to Bloomberg. Going back to 2014, more than 57% of the debt blowups come from the real estate sector, including Tianjin Real Estate Group of 8.2 billion yuan notes. This is where we keep, again, there's that bifurcation of what is doing well, what is struggling. And it's going to be hard to see this, we keep hearing about a commodity super cycle. It's going to be hard to see that really happening with China really trying to cut and reduce some of their spending, especially in the infrastructure space. When we look at just building on transportation and some of these others, they've put out these lofty goals, but those have been kind of walked back to a greater extent. And then property declines further in Q1 in contrast to reports of a still booming sector. Headline indicators fell for a third month, with CapEx slipping, and every subsector saw growth on Q4. Residential and commercial real estate especially slumped. So we're seeing that those slowdowns come through, and it's back to debt levels. We're seeing some forced bankruptcies. We're seeing some rehashing and adjustments to total leverage ratios. So there's no quick fix. Economies rely heavily on labor-intensive manufacturing, known for its low wages, specifically in Zhengzhou. The city, located in one of the nation's most rural provinces, has made little progress in growing high value-added industries, which is why there's such a focus on rural revitalization, trying to connect these countries and these provinces to the rest of the country to increase flow, increase economic activity, increase total economic just capacity, because is that underlying issue. So the city's residential land sales, a leading indicator of housing investment, fell more than a third in the first 2 months of the year from a year ago, as many developers chose to suspend construction. The worst days are not over is the common thread. So then when we look at that rebalancing, so consumption is a shrinking share of final nominal output, and that's what they're looking to adjust. They want some of this movement, because China's rebalancing of its economy from investment-led growth of consumption, again, investment-led debt, is likely to slow in the coming 5 years as the population ages and the workforce shrinks. The share of consumption in gross domestic product is likely to rise at a slower pace compared with previous years. So they're trying to adjust that. They want it to be a natural movement and a natural buying in terms of kind of supporting that consumption, or the C side of GDP, because that's where they continue to see some of these headwinds. Beijing's longer-term goal has been to reduce reliance on debt-fueled investment as a growth driver and boost consumer spending in the economy. While consumption as a share of GDP has steadily increased in the past decade, it dropped last year as spending collapsed during the pandemic. That's what we're trying to say. They're trying to get this local consumption, and that's why the dual circulation strategy has become such a big focal point for what they're trying to achieve. Now, when we start looking at the real estate and construction, the transportation construction side, so the diffusion index, if the light blue is Q4 2020, the dark blue is Q1 2021. So you can see the shift down in a lot of this activity in terms of when we went from 2020 into 2021. And now it's still growing. I'm not saying it isn't. The data is saying it's growing. It's just growing at a very different pace versus what it was as they look to remove some of the ease in which capital is available. The PBOC has come out and said that they're open for tapering. They're looking to taper some activities. Some of it is being extended, but transportation construction in China really fell off a cliff in Q1, and which isn't what you typically see when you start looking at some of this. And this is coming from the China Beige Book, when they're looking at their diffusion indexes. And I find that they've been fantastic in really kind of getting in front of where some of this data is pointing. And that's where we see those issues on the new projects. And more importantly, when we look at the transport construction side, this is where we see some of the biggest slowdowns, because you're seeing provinces that are struggling to just finance previous projects under SPBs, which are special purpose bonds, and other types of loans that continue to be that cap. But where are they investing? So the number of venture capital and private equity deals involving semiconductor-related companies in China have surged and remain elevated. So you're seeing this shift out of, well, maybe we'll pause a bit on the development and really look at how can we increase semiconductors and the tech side, which remains, I think, the biggest focal point for how the CCP and really the economy, how they want to direct it and invest in general. So that got strengthened again when you look at that chart, because the Ministry of Finance and 2 other central agencies released a plan to cut import duties for all integrated circuitry and software companies until 2030. So they're trying to solidify this base. So you need to build more at home, but you need to import more because you're going to want to assemble more. You're going to need more raw materials. So the new measures raise the technical standards for chip manufacturers to be eligible for tax breaks. So you can't, it's making it harder while increasing. So again, it's getting more specific on what you can get this allotment for. So the line width standard is adjusted from 500 to 65 nanometers, requiring a much more advanced manufacturing technique. The criteria could be further upgraded soon, depending on domestic industrial development and technological progress. So they're trying to support at-home creation, but they still need the high-tech stuff, which is why they have to be very cognizant and specific as to where are they trying to mitigate this. So the new measures are designed to stabilize domestic chip supply chains. Exemption from import tariffs now apply to companies that import self-use raw materials and parts that cannot be produced in China. Self-reliance in high-end chips is still a way off, which is why they're trying to, say, look, we'll help support you with the low-grade stuff. We'll still help you with the import of the high-grade stuff, but we need to fix this in general, because policies like this will at least aim to ensure stability at home. But what is happening in the meantime? And we keep talking about the China credit impulses. The impulses have come down. We've shown that in a lot of our data, in what we've said in general. And here you can see a lot of this rollover, which again is going to pull back some of this commodity input, the index in general, which has seen this huge increase. And typically they move fairly in lockstep, but the big surge is coming from supply disruptions, raw material shortages. And this is where you're seeing some structural shortages in the market on raw materials, and oil just isn't structurally short. So again, this is why, I'm not saying this has to close the gap, but you're going to see this come down, and I don't see credit impulses adjusting based on some of the diffusion indexes and other things we've talked about. This is looking at steel rebar, steel hot cold rolled coil. You're seeing these prices just continue to roof, and that's gonna impact how is manufacturing going, which is why the manufacturing side, while positive, it was also driven by a lot of positive, moves in pricing, which is really going to kind of be more of a net negative when you think about the cost of exports. Because at what point does the market say, I'm going to wait, or I can't afford what you're trying to push towards us? So, but again, this is looking at the export side. So exports forecast for total, it's expected to recover from 2021. I don't believe that they're going to, I think it'll be in line with 2021, with 2020, slightly below. I struggle to see the catch up, or I should say, the move back in terms of the forecast. But again, this is a forecast, your guess is as good as mine. It's just when we look at how supply chains have moved and how things have shifted into more reliance on Vietnam, Taiwan, South Korea, Malaysia, Indonesia, which we'll talk about in terms of some of their export numbers. That's going to take away from some of this Chinese growth, which I think is going to be to the detriment of what this total number actually looks like. And just getting some support on that, when we look at corporate borrowings, state-owned versus private, you can see that the state-owned and has seen a big drop in the percentage of firms that are looking to borrow. So again, trying to take some of that liquidity out of the market, where the private has had to come back to, which is why the PBOC has extended some of those benefits to the private side, and why you had the Ministry of Finance essentially saying, look, you need to continue to support micro, small cap companies because they need help. And this is what we're seeing here, which again is supportive of that data. But as the SOEs pull back, that's going to cap some of what does that growth look like in the Chinese markets. And that's when we start looking at the Chinese manufacturing. The business confidence index remains at high. So even though we've seen some of these increases, the expectations are still there, and we still have to look at what do we expect? What are we going to see in general? And this is why we think this is going to come back a bit, especially as inflation starts to pick up and we see some of the lack of investment or bond or debt coming out, which is going to weigh on some of the business confidence indexes, which I think you can see here when we look at sales revenue and profit margin. Because if you can't push down those prices paid for prices received, you're going to eat into profit margin. So the profit margin is the one where, as inflation becomes a bigger problem, this is going to not only just flatline, but start to curl down, which is going to weigh on that business confidence. So even though orders are up, so are delay in deliveries, the cost of inputs. This is going to be that weighting, and we're still not even back to where we were, which again is that pressure that we continue to see in general. And now looking at capital expenditures, the capital expenditures have started to come back up, but there's still that the PBOC coming after. Now, again, this is their own words, trying to come after and reduce the amount of debt in the market and reduce that debt financing to generate growth. And this is what we're seeing in terms of that CapEx side. But while they're doing this, it's also because it's getting expensive. The China-US 10-year bond spread is seeing some of this pressure. You're starting to see some of these Chinese issues in general. But again, this is something where you had that big increase. You had some of the spreads coming through. Now you're starting to see some tightness. This is where we're starting to see some balance, and that's China started buying a bit more of treasuries, taking in a bit more dollars, trying to get in front of some potential inflation as we look at the inflation fears, I should say, about local currencies, because there is that movement in general. So then when we shift gears and we look at Japan, the 10-year JGB yield and tolerance band, so they're pushing against the top of that tolerance band, which means that the BOJ is going to have to do more to try to mitigate some of this pressure that we see here. And this is why or is it going to continue going up? I think yes, which is the market is going to push them and make the BOJ act. And I think that's going to be an interesting one to watch to see how much do they push? Because you can see here, when we look at through 2017 all the way through the middle of 2018, the market kept pushing it and saying, you're going to raise that, you're going to raise that. And then they finally did, and then it dropped off. So this is going to become a bigger problem, I think, over the longer term as the market tests their resolve at the top of the band. And this is all happening as job application ratios have gotten better, but still remain under a certain amount of pressure. So you see that slowdown, and it really started through 2019 and just maintained through essentially 2020. Again, coming to why we were seeing some pressure in the market, specifically on the Asian front. Then when we look at India, because we want to talk about this in different levels, the India staffing levels have gotten better. They're still net declining, but they're getting much closer to that flatline component. But now with the rise in COVID cases and the slowdown of activity, this is something where, as we've been saying, it's gonna flatline a bit, and it's gonna not pull back, obviously, but it's going to come to and then level off at this component, just because it's really hard to see that acceleration given how we already had a slowdown coming from January into February, now February into March, and now March into April is that continuation, which is just going to be that cap on where we see that the Indian economy going. And here's just an example where you see the external borrowings and the combined credit growth is very weak, and it comes down to just what is inflation looking like? What is the backdrop of borrowing, where the RBI has had to step in on several different occasions to backstop some of this, some of the borrowing. And this is why monetary policy has to be watched. You've had countries turn hawkish. You've had increasing rates because they want to promote the fiscal, but they need to try to adjust kind of where this sits in the longer term, which is why the external borrowings have really come down through 2020. And I don't really see that peaking back up. And the corporate borrowings and all of these are, again, is just going to stay at this, I think, a fairly tight level as they try to mitigate some of the additional borrowing, especially as rates have been pushed higher. So then when you look at the surplus liquidity in the Indian banking system, it's pulling back, and it's due to those rising yields, because the risk, they're trying to get in front of inflation, and inflation has gone up, rates have gone up, and they're trying to utilize monetary policy without raising rates. They're trying to show, look, we're paying attention. We know it's an issue. We're going to address it by not easing more. There was a lot of talk that a rate cut was on the table. I would say it's now off the table, but an increase isn't on the table because they're trying to promote that fiscal, and they're going to see some of these pressures as we see some of the banking system liquidity coming, pulling it out, trying to take some of that inflation down after that huge increase of about over 1%. So just putting it into context, when we look at COVID cases, here you can see as of March 28th, we're at 372,000. Active cases are now at 486,000, which is why the lockdown index is continuing to push closer to 70. So just looking at what we're seeing here, so road congestion compared to peak, New Delhi and Mumbai, when we're looking at some of the key aspects, data for the week ended March 26 show a further drop in road congestion to 59.5% from 63%. So again, walking back the wrong way. And then the mobility index ended at 21.7%, a contraction relative to the pre-COVID level, slightly wider than the 20.7% drop in the week previously. And the expectation is for us to continue to see a 22 or 23% drop. So again, India is coming under pressure because people are just naturally doing less to avoid. There's some lockdowns, which is why the flex schedule, the desire to work from home has increased, and then if you just look at, okay, well, the lockdown stringency index has gone up. Here's where we can see the active cases, pushing back towards those, essentially the same trend that we saw in June, which is the concerning side. But we are seeing Indian doses and vaccines. The issue is how quickly can they get disseminated? India is a very large country, and it's just, will the variants that are out there that tend to be a bit more contagious move through the system a bit faster? Is that going to outpace the vaccine, which is why they're trying to get ahead of it by having some of these local lockdowns? So then when we look at this a bit differently, this is when I want to look at Vietnam. So the COVID slowdown, Vietnam has been a bright spot. It's one that we keep talking about. So just some key details. So exports rose 19.2% in March, while imports climbed 27.7%. And remember what I always keep talking about, imports become exports in countries like this. And that's why the rise in imports is going to support an increase in a healthy export market. The boats suggest that in terms of what we're watching. So the country ran a 400 million trade surplus for the month, below expectations of a 1 billion, but that's okay as long as it's coming back into and getting pushed back out into the system. And based on how we've seen supply chain shift, Apple's moved more to Vietnam, out of China. This is going to be that net benefit. And then consumer prices rose 1.16% on year. For the January to March period, exports increased 22% from the previous year and imports 26.3%. So we are getting some inflation. It's manageable at that level. The question is going to be, managing that at a greater component to maintain the inflation at the level it's currently sitting at. Manufacturing, particularly on electronic equipment, phones, and accessories, was the main driver of the first quarter growth of 9.45%. Again, Apple shifting, so they need stuff to assemble. Pledged FDI, or foreign domestic investment, rose 18.5% in the first quarter, while dispersed FDI was up 6.5%. Bank lending rose 1.47% from the end of 2020 through March 19th, compared with 0.68% in the year earlier. Vietnam is going to be the one to watch, and that's why when I look at what is happening in China, I think they're going to lose out, or at least some of the growth that was expected is going to be moved into other supply chains, specifically Vietnam. And then when you look at percentage of Vietnamese exports accounted for by U.S. imports, you can see the supply chain shift, which is only going up, and again, kind of taking down some of that capacity. So then when we look at it on just the totals, just to put it into perspective, you can see just where those totals are on the export level and on the import level, which is keeping things fairly stable with GDP growth. Now, taking this to a different country, we can look at Malaysia. Malaysia trade, when we look at imports against exports, they continue to trend in the right direction. Some of the imports will have to stay robust. Exports will slow a touch. But again, you're still seeing that positive move in the ASEAN countries, the ASEAN 10, which is why it's so important when we're talking about the geopolitical side, because there's a lot of things happening right now. China, and U.S. continue to be in a move of commentary. North Korea is making noise into the by launching ballistic missiles. You have Iran, shaking things up, trying to meet with China. Then you have, when we turn to Russia and we look at, some of the assets that were there for a military exercise haven't left. They're right near the Ukraine border. Then the question is, well, is there going to be a bigger movement? As the spring thaw, which is typically right about now. Obviously some of these countries are cold. Some of these countries have inclement weather that makes the terrain very difficult to traverse. But as you start to get into spring, you start to see some of these movements. And these are going to be hot spots to watch. I don't think that there's going to be too much happening within Russia. Putin is more concerned about what is happening with OPEC. How do they get some of this debt out there? Launching against the Ukraine is not going to help them trying to get more debt. They're trying to manage that. So, or I should say, issue more debt. When you look at what's happening with Turkey into Russia, then as we come over into China and India, we're supposed to have a meeting. We're still waiting to hear on what came out from that meeting in March, because they have to have those high-level talks. Where are they going to go from here as we look into the next few months? Because again, we're coming to this point where we have to sit down and have a conversation. So a lot to talk about. Right now we're still in a wait and see mode. There's not too much in movements, and we'll kick off the beginning of segment 5 next week with some of those updates as we go forward. So if you have any questions, please reach out. Love the back and forth. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.